Most people don't realise they've made this pension mistake until it's too late, but a wrong move with how you take your lump sum could actually end up triggering a huge tax bill down the line. I managed to catch this just in time for one client of mine, and by changing strategy, we were able to add nearly £500,000 to his future forecast. So if you're planning on taking tax-free cash from your own pension, you need to watch this. Even if you think you've seen this topic covered before, I'll make a bet you haven't considered the solution I ultimately recommended. In fact, you might not even realise it's possible, but everyone who plans on retiring should be aware, in case it can apply to their own situation. And even though the example I'll be using is of a client who had a large pension and paid higher rates of tax, the same principles apply to other situations. So, Darren and Sarah are clients of mine that I started working with recently after Darren caught a few of my YouTube videos and decided to reach out. He was 55 and had decided he was ready for a change. He was tired of working overseas, and having just paid off his mortgage, he wanted to retire and spend more time with Sarah. And when he wasn't with Sarah, he wanted to be on the golf course. In the last 5 years or so, he'd started to earn a substantial amount through salary and bonuses, and he was paying the highest rate of income tax. He tried as much as possible to minimise this by maxing out his pension contributions every year, and this had allowed him to build up a pot worth £925,000. Sarah was only 45, so quite a lot younger than Darren, and she didn't want to finish work yet. She only did 3 days a week and felt she had a pretty good work-life balance. In terms of finances, pretty much all of the assets were on Darren's side. Sarah did have a pension with £60,000 in it, but she just made the minimum contribution to it from her 25k salary. Together, they'd worked out they needed just over £4,500 a month, so about 55k a year after all taxes, part of which could be covered out of Sarah's income. Now, it's fairly common knowledge when you draw pension income that there are two parts to it, a tax-free element and a taxable element. You can take 25% of your pension's value as a tax-free lump sum, and the rest of it is treated just like salary and taxed accordingly. The only difference being you don't pay national insurance on it. But depending on how much income you access every year, the tax could be as high as 45%. For that reason, most people know that taking too much of the taxable part at once is a bad idea, and they don't do it. But it's the tax-free part that often lulls people into a full sense of security, and where the biggest mistakes are made. Darren's plan before he came to see me for advice was to access all of his tax-free lump sum at once to securely provide for his expenditure needs over the next few years. And to be fair to him, he'd done his research, and by using a combination of fixed-rate savings accounts and UK government bonds, all maturing at staggered dates over the next 5 years, he was not only able to get a solid rate of return on his money, he would get it all completely tax-free. The rest of his pension pot could then be left alone completely for a number of years, and because his short-term capital wasn't at any risk of loss, that would give him plenty of comfort to leave the pension investments in a higher risk environment to hopefully attract more growth. That would then be used to support him and Sarah later in retirement. Now, on the surface of it, this all sounds like a very good plan. I've mentioned in many previous videos how it's wise to hold a cash buffer in retirement, to draw upon if markets get choppy. Doing this can protect your overall pot by ensuring that you don't have to draw from your investments when their values have fallen. However, there are many ways of gaining this protection. And when we looked at the forecasts, Darren's plan was actually very inefficient over the long term and was likely to cost him a lot of money, as we're about to see. I used my cash flow modelling software, VOYANT, to map this scenario out for him. And by the way, you can access everything I'm showing you in this video to plan your own finances. I'll tell you how a bit later, but we can see in this tax projection that in the short term, it all works quite well. The only tax being paid is the fairly small amount on Sarah's income. But when the cash is used up in several years' time, the amount jumps because Darren's withdrawals are now all coming from his taxable pension. And when Sarah finishes work completely, which she estimated would be around 10 years' time, all expenses are being funded from Darren's taxable pension. To meet their £55,000 a year target, which we've assumed will have increased with inflation, it would cost him around £76,000 a year. It might have avoided the taxman's grip initially, But in just 10 years' time, over £15,000 is being paid to HMRC. And that is then expected to continue rising year on year. To contrast that plan, though, I showed Darren and Sarah a different scenario, where instead of taking his tax-free cash all in one go, he took it gradually, alongside taxable pension withdrawals. So out of the £35,000 Darren roughly needed to withdraw in the first year, £26,000 was taxable and £8,600 was tax-free. And we can see from this projection that although there is more tax paid initially, the increases aren't as significant in the future. By the time Darren's 77, he's expected to have paid £82,000 less doing it this way. More significantly though, Darren and Sarah's assets are projected to be over £246,000 higher at the end of the timeline. This shows that a gradual approach can save a fortune in the long run. Now there are two main reasons for this. One is that if Darren takes all his tax-free cash today, that's it. It's all gone. £231,000 is all he's getting. If he takes it on the drip though, his pension pot can grow higher than it is today. And as his pension grows, his tax-free cash increases with it. Ultimately, he could end up taking out £268,275 without tax, which is the current lifetime limit. Secondly, every pound of tax saved is a pound that remains invested in Darren's pension. So the less tax he pays, the more money there is to keep growing, and that leads to much higher asset projections in the future. Now I know there's always the chance that the amount of tax-free lump sum you're allowed could change in a budget, and we'll never know that until afterwards. But it's always best to plan based on what you know now, rather than trying to preempt what might happen. In my experience, when you do that, you tend to end up worse off more often than not. It's probably worth saying as well that this topic has cropped up prior to every budget ever since I've been a financial advisor, over 20 years, and nothing has changed yet. I'm not saying it won't, but I do think it would be an inefficient way for a government to raise extra tax revenue in the short term. And I'll explain why in my next video. So make sure you subscribe to not miss that. So, by making these changes, we can clearly see a very large improvement. But even though we'd made Darren's withdrawals more tax efficient, the bulk of the pension assets were still in his name, risking higher taxes down the line. But there was another way we could boost this plan significantly. While Sarah's still working and contributing to the overall household income, it reduces the amount Darren needs to take from his pension. And it means that Darren will remain a basic rate taxpayer in this period. So what he could do is take extra tax-free lump sum and income from his pension and pay it into Sarah's. As long as he doesn't push himself into the higher rate tax threshold when doing this, it can work out very nicely. The tax rate Darren would pay on withdrawing the extra money would be 20% on the taxable portion and nothing on the tax-free portion, which creates an effective rate of 15%. He then pays the excess money he's withdrawn back into Sarah's pension, and that receives a top-up of 25%. So between them, they get more tax relief awarded than has actually been paid. That's the first bonus. But it also builds Sarah's pension pot, which can be used to meet some of the household expenditure in future, rather than just relying solely on Darren's pension. From age 57, she could take all of her personal allowance, which is the first part of your income that you get tax-free, plus some tax-free cash from her pension annually. That's currently a total of £16,760 a year, on which he'd pay no tax at all. But if the same was taken out of Darren's pension, he'd pay 40% tax on 3/4 of it. I forecasted this into their plan and worked out that we could pay a further £23,000 into Sarah's pension to push her total contribution right up to £25,000, which would be her maximum. In doing so, Darren would remain in the basic rate tax band, and it would cost him roughly £2,800 in extra tax. Sarah, however, would be awarded £4,600 in additional tax relief, an £1,800 positive difference. Thank you very much, HMRC. From age 57, we'd then use her allowances to take pension income, reducing what we're taking from Darren's, and possibly even keeping him a basic rate taxpayer. Now, although we were effectively moving money from Darren's pension to Sarah's, there was a way we could do it even more efficiently. Because all of their income was just coming into one pot, we didn't need to distinguish what was Darren's pension and what was Sarah's salary. So Sarah was able to give up part of her 25k earnings and ask her employers to pay what she sacrificed straight into her pension instead. Her company still had to make sure she was at least paid the minimum wage as a bottom line though. And based on her hours, that minimum was around £15,000 a year. So she was able to give up £10,000 of salary in return for it being made as a pension contribution, which meant she saved £800 a year of national insurance as well. Darren's excess pension withdrawals then made up for the income Sarah sacrificed and funded the remaining £13,000 of her top-up payments. The savings that these actions create through retirement improve the projected asset values by nearly £243,000 versus the previous scenario, and a massive £489,000 compared to Darren's original plan. This is why it often makes sense for couples to plan jointly rather than doing things in a one-sided way and ignoring how a spouse's tax allowances could improve the overall income picture in future. Now, some of you might be aware of what are called the pension recycling rules and are currently wondering whether this is all allowed. Well, the answer is yes, it is. Those rules prevent someone from being able to take tax-free cash and pay it back into their own pension scheme to benefit from tax relief on what they've received tax-free. But the rules don't prevent someone from paying it into a spouse's pension. So if your situation allows, this is all perfectly doable. And like I mentioned at the start, just because you may not have a retirement pot as big as in this example, doesn't mean the same options aren't open to you. Now, as a bonus, I've got another little nugget for you that could save you a lot of tax, and I'll tell you that in a moment. But I think what we've looked at so far shows that it really is important to look ahead and analyse your position to see what advantages can be gained at various points in the future. This is what you should either be working with a financial planner to do or doing yourself using the right tools. The ones I've demonstrated in this video are available for you to access via my online course. There's video tutorials that show you how to create plans like these for yourself, or we can create them for you initially if you prefer, and then hand over the reins, whatever works for you. But there's a link in the video description. So, another big mistake I see is people wasting their valuable tax-free personal allowance by letting their pension sit idle for years after they stop working. Currently, you can access your pension at 55, and that will rise to 57 in a couple of years' time. But many just leave their pension sitting there after this age because maybe their partner's still working and they don't need the money. What eventually happens, though, is that they do start drawing money around the time they get their state pension. And because the state pension uses up a large part of their personal allowance, most of their private pension withdrawals are then taxable. Now, assuming they weren't already putting the maximum into their ISA and weren't receiving income that used up all their personal allowance, it would be far better to take pension withdrawals up to that allowance straight away and pay that money into their ISA. It can be invested in exactly the same way. But when their state pension starts, the ISA holdings are still accessible, totally tax-free. I call it personal allowance deferral. It means that valuable 0% tax band isn't being wasted. It's like being bought a gift card for your birthday. If you don't use it within a year, you lose it. Now, there's one important thing to remember here. You should only do this if you have no intention of returning to work and making large pension contributions again in future. Because as soon as you take taxable income from your pension pot in this way, you're restricted on how much you can pay back in. So we've talked today about why it's not a good idea to take your tax-free cash straight away. But I'm throwing you a curveball here, because there is at least one scenario where it is the right thing to do. I'll be covering that in my next video, so be sure not to miss that. In the meantime, I'd recommend watching this one next for another powerful example of how scenario planning allows better decision making. I'll see you there.